Hello everyone, and welcome to the webinar on taxation of stock options, commonly known as ESOPs. Now, ESOPs is a complicated topic and a lot of you might have a lot of questions on it. Through this webinar, we intend to solve all your queries. This session is going to be conducted by Chetan Chandak, who is Head of Tax Research at H&R Block, India.
Welcome everyone. So today through this webinar we will be knowing about what is ESOP and how its taxation works for India taxes. So what is ESOP? So few of you might be already aware, few of you might be wondering what is ESOP. So let's see. So ESOP is nothing but an option granted to you to purchase or acquire a particular number of shares of your company. Being an employee, that is a right given to you. It's just understand friends, it's not an obligation at all. So if you wish, only then you can exercise that option. So we already said there are certain numbers of shares which are given to you under that option. So under this option you can purchase the shares at a predetermined price which is decided at the time of granting those options to you, and you can purchase these shares at a future date on the price which is decided in past already. So it means that whatever appreciation happens into that shares price from the date of grant till the date the shares vest to you, that is your profit, and it is taxed in a certain way under the income tax. So we are going to see that how it is taxed subject to fulfillment of certain conditions. So there are certain conditions which are always attached to any ESOP option. So it may be particular number of years of service or achievement of particular target or anything. So there are certain conditions attached to every stock options. Those are called vesting conditions. So why stock options are given, or what is the objective of stock option plans or sweat equity plans? The main important objectives are listed here. Reward the performance of and loyalty of the employees. So company wants to reward certain loyal employees, so they grant stock options to those kind of employees to enhance the retention of human capital. So if company wants to retain a particular human capital or a work employee, so company grants him a particular number of stock options which vest to him after a particular vesting conditions are satisfied. To attract new talent from the market, so there are some skilled laborers for which company may not be able to afford him to afford a particular salary. So the company gives him an option that you come to our company, we will give you our company's certain number of shares, and with your hard work the value of shares increases and you also get benefited out of that value appreciation by appreciation in the share prices. Reward to the high performing employees. So these shares, so it also serves the purpose of rewarding the high performing employees. Like if somebody is performing exceptionally well, so company offers him certain numbers of shares of the company because he is contributing to the growth of company. So company also want him to earn something out of his effort. So that's the reason the stock option also helps him in getting some benefit out of that. Enhance productivity and motivate employees with no cash outflows. Importantly, for companies, as the compensation is given in the form of shares, there is no cash outflow for the company, but employee can sell the shares in market and realize the gains of that. Key driving factors of stock option plans. Important factors are improving shareholders value. So it helps the company in enhancing shareholders value because the share prices of the company increases with the efforts of all the employees, and then shareholders value also increases with that growth. It creates a sense of belonging and ownership in the employees. So stock options, once an employee is granted a particular number of shares or stock options to acquire those shares, he feels like a owner of that company and he puts effort in that direction for the growth of the company so that he also gets rewarded out of that. So it creates a sense of ownership or belonging to the company. Retirement plans for many employees. So stock options are also granted for certain employees, like if they are serving for a longer period, So then they get certain number of shares at their retirement. If the plan is that way, it also helps employees for their retirement planning. So now, before we jump to the taxation of ESOP, there are certain important terminologies which one should understand before they jump to taxation, how it works. Because based on these terminologies only the taxation will be determined. So most important terminologies are listed here. So first one is grant date. So grant date is nothing but a date on which company gives you an option to purchase those particular number of shares. Vesting date. Vesting date is a date on which you satisfies the vesting conditions which are attached to the stock options. So once you satisfy this condition, then only you become eligible to exercise the stock option. So this date on which you satisfy the condition is called as vesting date. So then obvious question is what is vesting period? So vesting period is nothing but the period between the vesting date and the grant dates. So it simply means the period over which you satisfy the vesting condition. So vesting conditions are those conditions subject to which, like if once you fulfill those conditions, then only you become eligible for exercising this stock options, or you become to you are entitled to purchase those shares. So those conditions are called as vesting conditions. Exercise date. So exercise date is the date, any date after the vesting date. So once the shares are vested to you, so you are given a particular period, say 2 months, 3 months, during which you can exercise this option. So the day on which you communicate to the company that you now want to exercise your option and purchase those shares, then that date is called as exercise date. So obviously exercise period will be the period between the vesting date and the exercise date. Any period falling between these two dates is considered as exercise period, because during this period you are entitled to exercise your stock option anytime. Now next important terminology is fair market value. Why it is important? You will come to know when we discuss about the taxation. But right now just understand what is fair market value. We are going to see it in detail. So fair market value is nothing but the price of your share at the time of allotment to you. When the shares are given to you, the fair market value or the market price of that share at the time when those shares are given to you. Exercise price is the price at which you purchase those shares. So some of the stock options, under some of the stock option schemes, you may have to pay a particular price to the company and purchase those shares. So that price, if your stock option scheme has some condition that you have to pay a particular price, then that price is called as exercise price. Just let's take an example to understand what are these different terminologies means. Say on 1st April 2014, an employee stock option was granted to an employee for purchase of 500 shares at rupees 100 each, subject to 2 years continued service, to be exercised within 90 days of vesting. Then on 15th of June 2016, when the market price of the share was 400 per share, the employee actually exercised his option and purchased those 500 shares from the company. So now the question is what are these different dates or period means to you? So let's see it one by one. Grant date. In this particular example, what will be the grant date? It will be 1st April 2014, because on this date the option was formally agreed upon between, the scheme was formally agreed upon between the employee and the employer. So this is called as the grant date. So 1st April 2014 will be grant date. Then vesting date is the date on which you satisfy the vesting condition. So the vesting condition here is 2 years continued service. So this 2 years will be completed on 1st April 2016. So that becomes your vesting date. Now vesting period, the period between vesting date and grant date. So that period is 2 years period. Vesting conditions, we have already discussed, continuous service of 2 years. Exercise date, important. So exercise date is any date between 1st April 2016, because that is your vesting date, till 30th June 2016, because we said that the employee can exercise anywhere between 90 days from the date of vesting. So that date can fall any date between 1st April to 30th June 2016. In this particular case, as the employee exercised the option on 15th June, it will be 15th of June 2016. Exercise period, here the period given for exercising that option is 90 days. So the exercise period is 90 days. It is of not very big importance, but sometimes it is like good to know. Fair market value. So the price at which on the date of allotment. So here on when the shares will be allotted to you on 15th of June 2016. So it means the price on the date of allotment will be your fair market value. So 400 is the fair market value. So now exercise price. So in this particular case, the employee has to pay 100 rupees per share to acquire those shares. So that price is called as exercise price. So here rupees 100 will be your. Hope that clarifies the different terminologies. So with that, we will move to the next slide, that is types of incentive plans. So there are different stock option plans or employee stock option plans are available, or we can see in economy. So these are employee stock options, what we call ESOP or ESOS, employee stock option schemes. So these are nothing what we discuss, but there are some different variant of this, which are employee stock purchase plan. Under this employee stock purchase plan, you are given an option to purchase the company's shares at a discounted price after a particular period. So so here you have to purchase the shares and you get a discount. So this discount is your profit. Another variant is share appreciation right or phantom share. Why it is called phantom share? Because in this particular plan you are not actually allotted any shares, but you are rewarded in the form of appreciation which happens in the share price from the grant date till the vesting date. So suppose a share on grant date share price was 100 rupees, and on the exercise date or on the vesting date the price has become 200 rupees per share. So this gap between 100 and 200, that is rupees 100 per share, will be considered as your stock appreciation, and that will be your income. So restricted stock awards and restricted stock units, RSUs and RSS, though these terminologies are not very common in India, these are more commonly used in USA, where restricted stock units means the shares, it is nothing but a stock option plan where you are awarded the company shares without any price, subject to fulfillment of certain vesting conditions. So once you satisfy those vesting conditions, you immediately become entitled to the exercise of those shares, and you don't need to pay any prices. RSA, restricted stock awards, again something similar to RSUs. Only difference is in RSU you become owner of those shares only when you exercise those shares after 3 years or after satisfying the vesting condition. But in case of restricted stock awards, you become the owner of the shares from the first day. So any dividend, bonus or anything which is given on those shares, you will also be entitled to that dividend or bonus. So that is the difference between RSA and RSU. So with this we will move to next slide, which talks about history of taxation of ESOP. Though history may not be that relevant, but just for information we will just go through it. Up to 1989, no specific provision was there for taxation of these ESOP gains. It were taxed as perquisite in the hands of employees, and it was included in salary, their regular salary. Post 1999 till March 2007, concessional tax treatment was given to this qualified ESOPs. There were certain conditions subject to which the ESOP scheme was considered as qualified stock option scheme, and the gains were subject to taxation as capital gain, and the taxes has to be paid at a lower rate. So if the share is listed, then probably you don't pay any taxes if it is a long term gain, or If the shares are not listed, then it is subject to indexation benefit as well as long-term capital gain tax of 20%. Otherwise, it is taxable as per your slab rate. So now this has become history. So again, after April 2007 to March 2009, there was FBT regime, fringe benefit tax. Under this, your employer was supposed to pay taxes on the value of ESOPs on your behalf. Employer has an option to recover that taxes from employee. But now again, this has also become history. So what is relevant for us? Post April 2009. Sorry, post April 2009, it is taxed as perquisites in the hands of employee, to be discussed in next few slides. So we are going to discuss this at a few slides. So tax treatment of employee stock option is divided into two parts, for employee and employers. We are concerned with more with employees taxation, so it is further divided into two parts, at the time of allotment and at the time of you when you actually sell those shares. So when the shares are allotted to you, the difference between the fair market value of those shares when you exercise those options and the exercise price which you have to pay to the company for getting those shares, the difference is taxed as the perquisite and it is included in your taxable salary. Now, when you actually sell these shares in the market, so whatever sale proceeds you get from the sale of those shares minus the fair market value which was considered for your calculation of perquisite value, that is fair market value on the date of exercise. The difference between these two, that is fair market value on the date of allotment and the sell value, is considered as capital gain, and depending on the holding period it can be considered as short term or long term and taxed accordingly. Now for employers, shares issued on or after 1st April 2009, no tax liability is there in the hands of employer as the FBT is already abolished. Fringe benefits tax was abolished in 2009. So there is no tax to be paid by the employee stock option now onward, means 2009 onwards. So we will just continue with the earlier example. Say on 1st April 2014, an ESOP was granted to Gaurav for purchase of 500 shares at rupees 100 per share, subject to 2 years continued service. Same example. Then on 15 June, when the market price of share was 400 per share, employee exercised his option and purchased these 500 shares. After holding it for 2 months, he sold it on 16th of July 2016 for rupees 500 shares. So now we will see how the capital perquisite will be calculated and capital gain. So there are few important terminologies which we already discussed and which are noted here. So how taxable perquisite will be calculated? Fair market value minus the exercise price which you have to pay for acquiring those shares. So what is the fair market value on the date of exercise? Rupees 400 per share. Less what you are paying for acquiring those shares, 100 rupees per share. So your perquisite value per share is rupees 300. Now what total number of shares are allotted to you? 500. So 300 into 500. So rupees 300 into 500 shares. So the total perquisite value becomes 1,50,000. And this perquisite will be added to your regular salary and tax accordingly as per your slabs. Now what happens when you actually sell those shares after acquiring those shares? So suppose the price went to 500 per share after exercising and the fair market value at which it was allotted to you was 400. So the difference between the two is rupees 100 per share and 500 number of shares you sold. So total 50,000 will be your short-term capital gain because the holding period is only 2 months. So that's how it is taxed. So perquisite valuation rules, see, we already discussed that this is considered as perquisite and perquisite is also included in salary. So salary, the definition of salary which is given in Income Tax Act says that salary also include perquisites, and section 17(2) also says that perquisite includes the value of any specified security or sweat equity shares allotted to you. It means the perquisite also includes the value of your stock options. So that's how it is taxed as perquisites, and this is the reason why it is included in your taxable salary. So how to determine the value? So we have already discussed that ESOP, the value of ESOP shall be the fair market value on the exercise date as reduced by the exercise price. So difference between the fair market value and the exercise price is considered as the perquisite value. Fair market value, what does fair market value means to you? We will see in. So there are some statutory provisions, that is rules given according to which in case of listed shares, average of opening and closing price of that shares on the date of exercise in recognized stock exchange whichever has highest volume. So in simple words, in case of listed shares, average of the share price on the share stock exchange where there was highest volume recorded on that particular date. In case of unlisted shares, the specified date of shares as so value of the shares as determined by the category 1 merchant banker. In case of unlisted shares, those shares should be valued by category 1 merchant banker, and that value will be considered for the calculation of perquisite value. In case of share ESOPs not being equity shares, so there are some incidences where ESOPs are granted for even debentures or other securities of the company. In those cases, the value of those stock options will be determined by the category 1 merchant banker who is registered with SEBI. And the specified date as mentioned above should be the specified date may be the exercise date or any date not falling beyond 180 days earlier than the exercise date. So the valuation, the fair market value can be any value which falls within 180 days, that is 6 months prior to the date of exercise. The value of the ESOP options is determined. So now see, taxation of ESOP in case of internationally mobile employees, it is very important because in this case, if they know the taxation good properly, it can save a lot of taxes. How? See, there are certain relevant provisions which I want to quote. So, in case of before I come to that, I would like to give you a background why I am saying that you can save a lot of taxes. Because in case of non-resident employee or not ordinary employee, only income which is earned in India is taxable. So now residential status is determined according to section 6 of the Income Tax Act. So once you decide that your residential status is resident, non-resident or not ordinary resident, then you see whether the income is earned in India. So then section 9 subsection 1 of the Income Tax Act says that any salary income is considered as earned in India only if the related services are rendered in India. So if the vesting conditions, so the vesting conditions are partly served in India and partly outside India, or the vesting conditions subject to which you become entitled to the ESOP options, if those are served outside India, so then it is considered that that particular portion of income is earned outside India. And if you are non-resident during that period, then probably you will be able to exclude that income from taxation in India. So DTA also has similar provisions. So DTA Article 16, Dependent Personal Services. So generally the article number which talks about the dependent personal services, nothing but salary, is 16. So this article talks about that the income which is it gives the right to the country where the income is earned. So taxing right vests with the country where the salary income is earned or where the related services are rendered. OECD commentary article 15 also has similar provisions, and there are some case laws which also supports the view where you can source the income based on the vesting period which is served in a particular country. So if you serve the vesting period partly in India, partly outside India, so you can allocate that portion to the particular, offer it for taxation in that particular country. So taxation of then so there are some international law positions. So Article 16 of DTA with most of the countries gives a right of taxation of income corresponding to the period of service in respective country. That is sourcing of income in proportion of the period of services rendered in a particular country. OECD commentary, as we already discussed, OECD commentary also says that general rule, as a general rule, taxation of income of employment other than pension, namely that such income is taxable in the state where the employment is actually exercised. So what the OECD commentary says that employment income is generally taxable in the country where the employment is actually exercised. Employment is exercised. So employment is exercised at the place where the employee is physically present. So if during the when the time during which you render those services, if you are physically present outside India, it will be presumed that you have rendered those services outside India and the income is earned outside India. In other words, ESOP perquisites is taxable in the country on the basis of number of days of services rendered in that country. So it simply means that the ESOP perquisite or the perquisite will be taxable based on the portion of services or the number of days which you serve in a particular country. So if the vesting conditions are spread over two countries, then you can apportion that income for the taxation purpose over those two countries. Let's take an example to understand this. Say on 1st April 2014, an ESOP was granted to Gaurav. So we are continuing with the earlier example where Gaurav was granted 500 shares at rupees 100. So exercise price was 100. And Gaurav was in US for last 10 years. He came back to India on 1st April 2015 and qualifies as RNR for financial year 15-16 and 16-17. Here he qualifies as a resident but not ordinary resident for both the years 15-16 and 16-17. Then on 15 June 2016, when market price was 400 rupees per share, he exercised those option of 500 shares, and after holding it for 1 month he sold it on 16th of July 2016 at rupees 500 per share. So we have already seen how the perquisite is calculated in this case. So it will be 400 rupees per share minus the exercise price, that is 100 rupees per share, so 300 rupees per share, into number of shares, that is 500 shares. So the total perquisite value in this case is 1,50,000. But now the total vesting period is 2 years, that is 730 days. Out of this 730 days, the vesting period some of the vesting period was served outside India, that is in US. So he came back to India on 1st April 2015 and the options were granted to him on 1st April 2014. So it means that the period of beginning on 1st April 2014 till 1st April 2015, this 1 year was served outside India and the balance period was served in India. So 1 year outside India, 1 year in India. So out of 2 years, 730 days out of the total 730 days, 365 days in India and 365 days outside India. So we can apportion this perquisite value in two parts based on this number of days. So the perquisite value which will be allocated to India services 1,50,000 into 365 divided by 730, that is you will allocate this to India services. So exactly half amount will be allocated to India, that is 75,000, and the balance perquisite of 75,000 will be attributed to US services and it will not be taxable as in the hands of Gaurav in India, because Gaurav was RNOR for assessment year assessment year 16-17, that is financial year 15-16, and as the income is earned outside India, he has rendered those services outside India. That's the reason it will not be taxable in India because of his resident but not ordinary. So whatever we discussed, these provisions, there are so this treatment of sourcing of income to both the countries based on the period of service, this has been upheld by many of the court judgments which are listed here. So ITIT Delhi in the case of Robert Arthur case in 2013 has upheld this treatment. where you can split the perquisite value to the country where the services, related services are rendered. And there are some other judgments which support this view. There are few judgments which are against as well, but overall, going by the OECD commentary and other treatment of the which are listed in the Income Tax Act, we would suggest that you can split the income based on your actual period of service to a particular country. So here we have means like seen all the treatment of the taxation for ESOP. If you still have any doubt or any questions relating to the taxation of ESOP, you can post your questions and we will make sure that your all queries are resolved there. Thank you everyone. Thank you so much.